over 80 stocks with market caps over $10 billion that have fallen over 20% in the last 1 month. Not last year, not year to date, in the last 1 month. Here are the top 20. Big names: Tesla, Meta, Nike, Adobe, AMD, BlackRock, Ford, GM, FedEx, Shopify, Block, Square. Guys, you have to realize that the things we said in the past may have taken a long time to happen, but they were a part of reality. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. When we saw overvaluation, we said, listen, we don't know what spark will cause the explosion, but eventually a room filled with gasoline and a fireplace in the corner will explode. And this is the start of it. Wouldn't you say, Mo?
Yeah, absolutely. And it's all coming to fruition now. And we don't even think this is even close to the bottom. These are just big names that have fallen.
Not even close. We don't believe this is even close. We want to see people give up on Apple and Tesla and the other big names at the that's before we're sitting there saying we're close to a bottom. That's what happened in 2000. That's what happened in 2008. That's what happens in every major market bubble. Now, does that mean you should sit there and exit everything and run for the hills? No. Your job is to dollar cost average into low cost ETFs. What we do here on the channel is we've been teaching investing, value investing specifically, for the last 10 years and the last 3 years on YouTube. If you like this, I need you to subscribe to the channel. If you need to wait a little bit longer on this video, please do. But this channel will absolutely change your mindset on money and investing, and it'll make you a richer person if you adhere to the mentality, the emotional, and the process-driven way in which we invest. Now, like I said, if you want to buy individual stocks, you have to be aware of the emotional part of the market. And a stock going up doesn't mean it's always going to go up. Stock and a business are very different things. And when you buy if you buy a stock, you're buying a piece of a business. The second you understand that, you will be a better investor, guaranteed. I used to hear Warren Buffett saying that, right, Mo? Mm-hmm. But even then I was just like, yeah, but I mean, it's still a stock going up and down.
So it's funny. I kind of look at it this way. The CEO of the company, whatever company you want, owns shares. You are owning the exact same thing that they are owning.
Correct.
That's the way you need to look at it. You need to say, hey, I have way less shares than Tim Cook, but I have the same exact asset that Tim Cook has in Apple.
Well, you know what changed my viewpoint? Owning my own business.
Yeah.
When I own my own business and realized that, hey, if my business makes $100,000 this year and makes $1 million in 10 years, it's probably going to be worth 10 times more in 10 years than it is today. Mm-hmm. And once I understood that, I was like, wait a second, how is that any different for a stock?
Right.
And in the book, there was a great book. I think it was Richer, Wiser, Happier. Mm-hmm. William Green's interviewing somebody. I don't remember who it is. And he said, what was your epiphany? He said, well, I just looked back at history and I realized if you paid a normal amount of money for a company and the profit went up over time, the value went up over time.
Right.
And it was like, oh, it's so simple.
It is very simple, yeah.
And investing is one of the most amazing things because it's simple but not easy. The more complicated you make investing, the worse it becomes.
Absolutely.
The simpler you make it by focusing on cash flow and a reasonable multiple of cash flow, you're going to do pretty well.
Yeah.
So in this market with a lot of volatility, these guys, there are 80 stocks. These are only the top 20. And look at the market caps of these. These range from $750 billion all the way to $36 billion. There are 60 more that are between $36 billion and $10 billion in value that have dropped over 20% in the last month. But I want you to subscribe to this channel because this channel will teach you to look at a stock as a piece of a business. We'll teach you how to read an income statement, how to read a balance sheet, how to read a cash flow statement, how to use our 8-pillar process to sit there and understand investing. We use our 8-pillar process. For example, Microsoft. We look at this 8 pillars right here. And we use this to understand where Microsoft is today. And then we use assumptions about the future to put into our stock analyzer tool to determine what price to pay for the stock. This is the most popular part of our site because it allows our users in our community, the thousands of people in there, to be able to make assumptions about the future for a company, a low, middle, and high assumption. Be conservative, be about where you think it's going to end up, and be more aggressive if things work out for them to see a range of where the stock could go. That's all investing is, guys. Investing is about making assumptions and seeing a range of where the stock could end up. And your goal is to have margin of safety and to buy it at a discount to the more reasonable range.
Right.
And that's all we've done. When you see our videos, we have over 1,800 videos in our channel. Our videos in our channel, the goal is to look at all investments. We talk about real estate, we talk about business, we talk about stocks the most because they're the most time sensitive and the barrier to entry is very low. But any other way we look at it, I look at investing as one thing. What am I paying today for a future cash flow? That's it. Now, there are multiple factors that will affect that cash flow.
Of course.
The growth potential of Microsoft versus another company I might be looking at. The margins of Microsoft versus something else. But at the end of the day, I'm looking at long-term averages and seeing where companies are selling today based on a long-term average of what people expect for returns. Remember, right now you can invest in a 10-year treasury and get about 3.8%. So what's the premium you need in order to invest in an equity? That's the question. That's one of the questions you need to ask yourself. And that's what made this bubble happen because that 10-year return went down to 0.5, 0.6%.
Hey, people go to stocks.
Hey, I get a dividend for 2%. I can get a dividend for 1.5%. I might as well invest in that.
Exactly right.
But what they forgot is you have capital loss potential with that.
And people are finally seeing that right now with all of these stocks that are just coming pummeling down from these ridiculous highs that they were at.
And why were they at ridiculous highs?
People were flocking to them and just saying, hey, stocks only go up. They're paying anything that they wanted to for the valuation. So you go and look at Tesla. What do they generate? $80 billion in revenue?
I don't think
billion,
even, 60 or 70 billion.
And people were giving them a valuation like they were doing $500 billion in
Actually,
revenue.
more than that.
More than that. So,
based on me, a car company, the average car company sells for half of its sales, and Tesla was selling for $1 trillion when that assumes about $2 trillion in sales.
Yeah. So you're looking at, there was a lot of people saying, well, Tesla is going to do X.
Great.
Or Spotify is going to do X. Well, now they're not.
So let me give you an analogy there. 96% of the people watching our channel are men. Men, for the most part, love sports. Do you go give a high school phenom the maximum contract in the NBA just because they have the potential of being the NBA star? No. Why? Let them get there. Mm-hmm. Same thing with stocks. And you'll see in every bull market, people will assume every company is the next X.
Yeah.
Whatever the next company, it's the next X. So why are we giving it a value higher than that X when it hasn't even achieved that yet? You're leaving no more meat on the bone.
Let them get a couple of seasons under their belt, see if they can actually prove themselves.
Yes.
Like today, right now, Aaron Judge is a great example of that. I thought that Aaron Judge was going to be figured out. I thought baseball was going to figure him out and he wouldn't be that great. This year he came out and hit 62 home runs. I think he's going to deserve whatever contract he gets. He's proven that he can do it multiple seasons in a row.
Speaking of which, is he going to resign? Is it the Yankees going to do this?
I don't think it's going to be the Yankees.
Really?
I don't think so.
Why is that?
I don't. The way that he was talking in multiple interviews, I think that he's maybe going to the Mets. I mean,
wow.
There was a deal. Harold Reynolds from MLB Network said that there was 100% a deal done for him to be traded during winter meetings to the Angels. The deal was done, but it didn't happen for some reason. So I just don't.
So what kind of contract do you think he's going to get?
I think he's going to get probably $500 million.
Dodgers are recruiting him?
I think it's going to be $500 million.
You think he'll get $500 million over how many years?
15 or something crazy.
I mean, that's not crazy.
Juan Soto just did 13 years, right? Wasn't that a 13-year deal? So I could see this going to 15 years. Judge is kind of older, though, in baseball terms.
He's 26, 27, isn't he?
I thought he was like 32.
I know. Oh, listen, baseball, guys, come on.
He's 30. He's 30. So
is he 30?
So 15 years would put him at 45 years old.
Wow.
I mean, even 12 years puts him at 42.
But remember, if it's a 15-year deal, so let's look at it this way. If it's a 15, I know we've gotten a little bit of a tangent, but I like these conversations.
There is a reason for us having these conversations.
Yes, it's all about value, and sports is very big on the value. But also, sports is a perception issue. That's the issue, and the public. I used to want to own a sports team. I came very close to owning a piece of the Miami Heat in 2008. Owning a sports team, well, first off, it's become too expensive for me. But two, the whole entire public, like all these fans saying, "I know better." That's what investing is. How many people tell me when I go to a golf course last year and a caddy is telling me how I don't get it on Tesla, Palantir, and Bitcoin, I just go, "Oh my God, this pimply kid who's a senior in high school is trying to tell me he understands balance sheets. He doesn't understand shit."
Yeah.
Right? Same thing, but in sports. So here's the other thing about Aaron Judge. If you do a 15-year deal at $35 million a year, that's a lot of money, right? $52 million a year. But 10 years from now, with the way sports is going and advertising going, that might be a reasonable deal for him. And that's why they're okay saying, listen, we're going to pay, basically in their head, they look at the $500 million, we're paying them $80 million a year for the first 3 years, and the rest of it's split up. And like, maybe that's their mentality.
Right.
And that can be justified, right? And that's sort of the thing that you look at here. Every investment is the present value of all future cash flow. If incomes in Major League Baseball are increasing at 7 or 8% a year, that last year of $50 million is really like $20 million today, or whatever it is.
And does Judge bring people to the ballpark? Is their fan base, is it jersey sales? I mean, one of the biggest things for jersey sales, remember when Browns drafted Johnny Manziel?
Oh, yeah.
The jersey sales went off the
I don't remember that.
I mean, I think it was the number one sold jersey at that time from one player coming out of a draft or something. It was insane.
Yeah, so there's a lot of other financial aspects, but remember, every investment is the present value of all future cash flow. And New York Yankees will do some sort of analysis to sit there and say, okay, yes, we're going to overpay him in year 10 through 15. But is it really overpaying him? If baseball salaries then are, if the highest contract then is 80 or 90 million a year and we're paying him 50, okay, maybe not. Plus, what if he breaks a couple more records? How valuable would that be for the Yankees? All these things. So same thing with a company. When you look at potential for a company, you've still got to factor in, okay, well, what if something doesn't happen? And the Yankees are factoring in there too. Okay, what if Aaron Judge just had a fluke season and all of a sudden he sucks? What if we find out he was juicing the entire time and gets banned from baseball or something crazy? Now, they won't have to pay him at that point. But these are all the factors.
What if he has a career-ending injury?
Correct. And they'll have insurance for that.
And whatnot, of course, right?
But that's the point. You have to look at a company the same way you look at these players.
Yep.
There's a lot of potential in high school. There's a lot of potential in the draft. There's a lot of potential, but you don't give the number one pick in the draft the number one contract day one.
Look at Billy Beane.
Yeah, Billy Beane went to, Billy Beane himself as a person.
As a player.
He was a 5-tool player who went in the first round of the Mets and did not pan out at all. On paper, he was perfect.
He was perfect. Yeah, exactly. You just can't predict it.
And there are unknowns. That's why we encourage margin of safety. So let's say, for example, the Yankees did their analysis and they said, you know what? We've done our analysis and Aaron Judge is worth $87 million a year to us for the next 15 years. If they pay him that, there's zero margin of safety. Zero. If they're wrong, because even though they do the analysis, they could still be wrong in their analysis. What they do is then say, okay, we'll pay him $50 million. That gives us a 25 or 30% margin of safety. Great. Now multiply that by 25 players. And that's the goal. Overall, you're paying a margin of safety on those 25 players. And overall, some are going to work way better than expected, and some are going to be duds. No different than your portfolio. Your portfolio should be made up of 20 to 40 companies with ample margin of safety. Enough of them will do amazingly well. Some of them will just be absolute duds and not do well. And the majority will probably do about what you expect. I just dropped my pen. That is the point of margin of safety. You apply margin of safety to everything you do in your life. The second you get in the car in the morning, you put that seatbelt on. You don't eat junk food all the time because you want to live a longer life. That's margin of safety. That is the whole point of it. But health is another example. If I eat McDonald's for the next 10 days, am I going to get cancer? No. But if I eat McDonald's every single day for the next 30 years, my likelihood of getting cancer is probably much higher than everybody else's. Doesn't mean I will. Same thing with investing. If you overpay for stocks, does that mean every stock you buy is going to go to zero? No. But if you buy 100 stocks you overpay for, you will not do as well. Right. That's just the reality. Unless you get lucky and catch the one Tesla who makes your entire return the way it is. That's just the way it is. And I cannot encourage this even more for you to listen to this way of doing things. So if you like what Mo and I have said, if it makes a little bit of sense to you, subscribe to the channel and watch our videos. I guarantee if you watch 4 or 5 videos, you'll walk away much smarter and much better at math and investing and money. Thank you very much.